Why is the global stock market up 20% this year, despite interest rates going higher, continued geopolitical instability in the Middle East and in Ukraine, and a banking crisis in the US? Here we can see that the market got off to a good start in January. Then there was a bit of a wobble in early March when Silicon Valley Bank failed. But the market was quickly able to shrug that off, and it rallied from March until July when it made a new high for the year. After that, concerns about interest rates intensified and the market fell from July to October. But in the last month or two, the market has again been able to go back up. Concerns about interest rates have gone down, and as a result, the market is now again at its highest level for the year. So why did we get such a good year this year? A large part of that is down to inflation. A number of factors have pushed inflation down this year. The first is commodity prices. Here you can see that the price of crude oil has fallen this year. And the same thing has happened with agricultural commodities as well, such as wheat. But perhaps more importantly, there has been progress on service inflation. Here you see the quits rate, which is a measure of the tightness of the labor market in the US. So you can see how tight the labor market became in 2021 and in 2022. It was very easy for people to find jobs. As a result, people were changing jobs frequently, and they were able to negotiate with employers for higher wages. But that situation has now changed a little bit, and the job market is not as tight anymore as it was a year ago. And as a result, you can see that the tightness of the job market has actually returned to the same levels as before the pandemic. You can see this reduced tightness of the job market in wage data. In 2022, wages were growing as much as 6-7% a year, but that pace has now come down to about 5% a year. It's probably still a little bit more than what the Fed would like it to be, but at least it's progress. So what does all of this mean in terms of inflation itself? Well, there's clearly been good news about inflation this year. Beginning of the year, inflation was running at about 6-7%, and now it's between 3 and 4%. Part of that is due to lower commodity prices, but even if you take the impact of commodity prices out of the equation, then you can see that so-called core inflation is running at about 4% at the moment. Or you can look at more sophisticated models, which will tell you where inflation should, in principle, settle in the medium run. So here is one example of such a model, and it says that inflation at the moment should settle around 3% over the coming years. This improved inflation picture is massive news for the market, because inflation has been the main thing that many investors have been worried about for the past year or two. And now that it's come down, then that worry has also abated. It has to be said that inflation is probably not the only reason why the market has done so well this year. Here you can see liquidity, and that has improved in the last month, which has also helped the market. So central banks have perhaps not been as aggressive as some feared. You can also see that liquidity has been an important factor this year from what kinds of assets have outperformed this year. So this year, cryptos and technology stocks did especially well. And these types of assets tend to do well when liquidity conditions are improving. So after a good year, what do I think will happen in the stock markets next year? I think it is still a little bit too early to turn pessimistic or cautious. And the reason for that is that other investors are still relatively pessimistic about the prospects for the economy right now. And here you can see that. So this measures the confidence of European investors about the European economy. And you can see that investors were really confident in 2007, in 2018, and in 2021. And these were good times to sell. But at the moment, investors are relatively pessimistic. And as a contrarian, that's a good sign. So I would wait until investor confidence increases to +20, +30 on this chart, and then I might start to reduce my positions. Since it's the end of the year, and I've been almost 3 years on eToro now, let's take a look at how it's been going. 2021, that was like an easy year for everybody because the market just went up. And my portfolio returned about 37%. Then 2022, that was a very different year because the market went down about 20%. But my portfolio returned about +2%, and that's because I was invested in the value parts of the market, which did much better than the market in general. And then this year has again been a totally different year from 2022. So the market went up around 20%, but it was a very narrow market. So technology stocks did fantastically well. They went up about 50%, but at the same time, many other parts of the market didn't go anywhere. Things like Chinese stocks even went down. So in those circumstances, I'm happy with the 30% return this year. I continue to be invested in the financial sector. There's currently 17 stocks in the portfolio. So we have a couple of US stocks here, MetLife, Unum, those are US life insurance companies. Then there's Interactive Brokers, which is a US brokerage firm. But there's more European financials here than US financials. So you have NatWest, you have Lloyds, those are UK banks. You have AXA, that's a French insurance company. Banco Santander, that's a Spanish bank, but a global bank. NN Group, it's a Dutch insurance company. BNP, a French bank. ING, it's a Dutch bank. Intesa, it's an Italian bank. Mapfre, it's a Spanish insurance company. Then we have KB Financial, which is a South Korean bank. Bank Inter, that's a Spanish bank. Credit Corp, it's a Peruvian bank. Then we have Beazley, which is a UK insurance company. And Coface, which is a French insurance company. So the common thread here is that all of these companies trade at valuations which are clearly below their own historical averages. So I think they are cheap, and that's why they are in the portfolio. But no discussion of the portfolio would be complete without also discussing the risks. Here is a headline from the Financial Times, which says that Moody's, the global ratings agency, recently issued a negative outlook for the global banking sector in 2024. So Moody's thinks that banks, especially in Africa, in the Middle East, could have to take more credit losses in 2024 than this year. And if I think about the European banks in the portfolio, it's certainly true that they are currently over-earning relative to the normalized level. So interest rates at the moment are higher than the normalized level, and as a result, the banks are making more money than what they will probably make over the coming years. Having said that, a lot of these risks are already in the price. So here is a chart of the valuation of Banco Santander, one of the banks in the portfolio. At the moment, you can see it trades at about 6 times earnings. The historical average has been 9 times. So there could, in theory, be up to 50% upside to this historical valuation. But investors are not willing to pay the historical valuation at the moment because of the risks of recession and the risk that the higher interest rates will eventually tip the banking sector into some kind of crisis, like we already saw in the US. So ultimately, it all comes down to this. Where are interest rates going to go? I'm quite happy that interest rates have now come down in the last month, because that lowers the risk of a banking crisis developing. So I would get more worried if interest rates went back up and even above the highs that they reached around October. So that would really increase the risk of a crisis. But at the moment, I don't see a crisis developing given interest rates are lower than in the recent past. So unusually, lower interest rates are now good for the banks. Usually, it's the opposite. So banks like higher interest rates, but if they go too high, then it's already too much. So I think banks are now in a kind of sweet spot, and I really believe that 2024 could be a year when banks outperform the general market index. If you liked this video, then you can follow my portfolio at etoro.com/people/triangulacapital. Thank you for listening.